afternoon. Thank you for joining us today for Joy Energy's operational update. The company has accomplished many milestones since our last webinar. Joy trades under the ticker symbol JOY on the TSX and JRNGF on the OTCQX. There will be an opportunity for Q&A post the presentation. Please enter your questions in the Q&A box or email me at jessica@adcap.ca. With us today from the company is President and CEO Alex Verge. Welcome, Alex, and I will turn it over to you to begin, and we can go from there.
Thank you, Jessica, and thank you to Adelaide for hosting this webinar. It gives us a great chance to get our story out there, and really appreciate all of you people tuning in to listen in the morning in Calgary, afternoon if you're listening on the East Coast. But thank you all for tuning in. We have a new corporate presentation. We just uploaded it at the beginning of May. It has a lot of new information in it. We've changed the theme of our presentation. The new theme is unconventional. And I think unconventional refers to a number of different concepts. The one concept is the Duvernay is an unconventional reservoir, and that's a key aspect of our future in the near, medium, and even long-term journey is the development of what I consider to be a world-class Duvernay resource. So we're going to spend a little bit of time talking about the unconventional Duvernay reservoir. And the other thing that unconventional can tend to mean is something different. And I'll highlight why we're different than the other microcaps. Before I get into that, I'll just highlight the fact that the cover photo for our presentation, what you're looking at, is basically a montage of the Duvernay core. So the Duvernay reservoir in the Willesden Green Basin, in the Western Shale Basin, is about 40 meters thick. And what you're seeing is just like pictures of the core that have been kind of montaged together on the cover there. So why are we different than other microcaps? Why are we not like the other microcaps? It's because a company our size with our low capitalization has a tremendous amount of things in it. A lot of things that we haven't been given credit for. First of all, we have a stable, low decline, predictable base. We also have an expanding polymer flood at Medicine Hat in a 310 million barrel pool. Not all that dissimilar to the flood that Hemisphere has. We also have an emerging power business, and then we have this world-class Duvernay resource play. Very few companies have one of these things in them at the microcap, and virtually none of them have all four of these things in them. And that's really what makes us different. We have a corporate snapshot in our presentation on page 3. I won't spend a ton of time talking about all of it. We exited the last quarter with 53 million of debt. We do have a brand new bank facility that was started in the first quarter, 77% undrawn. So we do have liquidity here in the company. And one of the things that I really want to draw your attention to on this slide is that since the fourth quarter of last year, insider purchases have amounted to over 1.5 million shares. So if you look at our information circular, I believe that you will see that Craig Hansen has increased his position year over year. This is the information circular that just came out for the AGM, from about 240,000 shares to 809,000. So he's up about 570,000 shares in the last year, and I myself am up about 525,000 shares. So that's almost 1.1 million shares that have been added, and a lot of them have been added since the 24th of March when we came out of blackout. Those shares have been added by the president and the chairman of the board. So a lot of confidence being shown by management. Management directors and AIMCO, our largest shareholder, own 32% of the outstanding shares in the company. This sort of situation map at a glance shows you the areas that we're operating in, shows you where our conventional assets are located in central and southern Alberta, shows you where our Medicine Hat polymer flood's located, shows you where our 3 power generation projects are located, And then it also shows you where the Gilby Duvernay joint venture is located. When we get into our business plan, you can see our first quarter there. You can also see the previous 4 years. You can see how the commodity prices change, and you can see how our funds flow has changed with commodity prices. Our debt kind of came out of COVID at about $100 million. Our debt peaked at the beginning of 2020 in the middle of COVID at $132 million. We wound up buying out the banks in at the end of 2020 in coming out of COVID. Our debt was reduced to about 90 million at the end of that. We reduced our debt all the way down into 2022, and then in 2022 we did a large deal with Enerplus, and that is what gave us our flagship Medicine Hat polymer flood. In 2023, we did some more investments in the Duvernay. We sold some land in the north of the Duvernay and acquired some land in the heart of the Duvernay. In 2024, we created a joint venture with Spartan and began drilling this joint venture in the fall of 2024, bringing on the first two new Duvernay wells in December of 2024. So the way I look at it, pre-2020, pre the bank buyout, it's kind of a journey 2.0 or 1.0. And then post that, it's kind of a journey 2.0 where we did a buy and exploit. We fixed our balance sheet. We went back to the Duvernay. We had a position in the Duvernay and it all expired through the COVID period. And we wound up getting it back and building on it in 2023. And then we wound up beginning to develop it at the end of 2024. So I consider 2025 to be almost like the journey 3.0, where we're now moving into a mode where we have a repeatable resource that we can exploit, and we're in the process of moving forward with that. We didn't provide any guidance because post-Liberation Day, it's been really difficult to get a handle on, the current commodity prices in the near term period. So we provided basically full year guidance based on whatever price you want to put in as an average and whatever price you want to put in for natural gas as an average and price for WTI. We had a pretty good first quarter. Prices were a little bit higher. So, I mean, obviously, you wind up being a little bit lower than these prices. If you look at $66, it could be it'll be a little bit better than that because we did a little bit better than that in the first quarter. So that'll give you an idea of where we're going for the rest of the year. As far as the net asset value of the company, we do trade at a significant discount to our actual net asset value. That's because we have an extremely long life reserve base. Our PDP reserve value is $4.33 a share, the blowdown value. You can see that the PDP values come down a little bit from 2022, and that's largely due to reduced commodity prices in the forward curves for the third-party reserve evaluators. But you can also see that the red wedge has come up a little bit in 2024, and that's the very beginning of the initial bookings for the Duvernay. But there really is a lot more to come. So if you look at that $4.33 a share, that's based on our PDP valuation, and our PDP contains only 17.1 million barrels of oil reserves. We have a roadmap growing that 17 million barrels of oil reserves from 17 to 70 million. And how that works is the PDP is based on a high level of confidence of about 90%. If you soften those declines, you get another 5 million barrels. That's the P plus P producing reserve life or reserve amount. Then you also have 15 million barrels outside of the Duvernay and outside of the Medhat Hat polymer flood that are largely located with infill drilling in our conventional pools and the opportunities in our conventional pools. And then you have another wedge on top of that. And that wedge is the potential for the Duvernay, which is in the neighborhood of 25 million barrels recoverable based on what our preliminary estimates are. And then you have another 10 million barrels to take the existing Manhattan polymer flood using the existing facilities and expand that over time through a significant portion of the rest of the Manhattan pool. So this slide is a tricky one to explain. I'm just going to cover a very simple concept here. People look at Journey and they look at it as an undervalued story, and they look at it undervalued relative to its net asset value. And it is undervalued relative to its net asset value, as you can see by the chart in the bottom right-hand corner here. So that's our enterprise value over our PDP value in our reserve report. We trade at a discount to PDP. That being said, we trade at more or less the industry average in terms of the value, the multiple of our operating income. So in our view, right now, we're in a slightly lower commodity price environment. There's a little bit of uncertainty in companies, especially on the smaller end of the scale. So in our view, the industry is basically trading at a multiple of cash flow or a multiple of operating income. And industry has sort of given up on thinking about net asset value. And so we traded a reasonable multiple of operating income, but a lower multiple of net asset value. The key for us is solving that by adding something that rapidly expands our operating income. And that's exactly where the Duvernay comes in. So I'll talk about how that's going to really help us in the future, ramp up our value, and kind of grow into this large net asset value that we have.
And just back
So
to your reserves, Alex, how much is in your reserve report for the Duvernay at this point?
in terms of oil, not in terms of BOEs, but in terms of oil, on a PDP level, there's very little. There'd be probably less than 1 million barrels. On a 2P level, yeah, there'd be about 5 million barrels on a 2P level. So that would have been that you know, the kind of that red wedge. We booked about 22% of the Duvernay locations. I'll talk about that in a slide when I talk about the drilling inventory of the company. Talking about the Duvernay, which, you know, obviously, in my view, Journey's success is primarily driven here over the near term or medium term by this Duvernay success. And it's happening, and it's happening in real time. And I'll tell you kind of what the next catalysts are for growth in the Duvernay. But we're in the middle of a 30% working interest joint venture with Spartan Delta. So to orient you around this slide, number 1 and 2 are 2 wells that were drilled in the fall of last year, and they came on at the beginning of December of last year. Very good wells. There's also 3 other wells on this map sheet, one south of the number 4, 2 of them that are just south of the number 3. Those wells were the original legacy wells drilled by Kiwetinohk. So we had a land position in the Duvernay. We farmed it out to Kiwetinohk. They drilled those 3 wells. They are very good wells, and they came on and have produced over 200,000 barrels each. And they were very good wells. However, we thought they overspent on those wells. They put a lot of water in those wells, and we thought that maybe they lost some drive energy out of the reservoir, out of the zone. So the completion program was redesigned, and more or less following the learnings of other operators over the years here. And the 2 new wells, number 1 and 2, came on at a significant improvement to the original wells. Based on that improvement, we improved our type curve, and based on that, we can see that our new wells are even ahead of the improved type curve. So number 3 is a 3-well pad. That pad was drilled in the first quarter. That pad was recently completed. We've had a couple of wells in that pad on. for about 2 to 3 weeks now, and the third well has just come on this week. So sometime within the next 30 to 60 days, you should start to see well results in the public market and press releases from us on the performance of those wells off of that pad mark number 3. Pad number 4, late in the first quarter and into the second quarter, we drilled 4 wells off of pad number 4. Those 4 wells are now in the process of being completed. We're just under halfway done on the completions of those 4 wells. So when you talk about journey and production from the Duvernay, 2 new wells came on in December of last year. In beginning of May, you're going to have, for half a month, maybe a couple of wells on. In June, you're going to have 3 wells on for most of the month of June. And then by July, some of the wells from pad 4 should start coming on, maybe 4 or 5 wells. And by August, you might have all 7 of these wells on. We also drilled a well up in the northern part. It's a green line north of the number 3. That well will not be completed this year. It'll be completed next year as part of the next year's program. So exciting incremental production coming from these wells. Net to Journey, these wells should IP at more than 300 barrels a day each, and really help us in the third quarter of this year in terms of production growth. The Duvernay type curve, as I mentioned, the old type curve, there's 3 wells on there in gray. Those are the legacy wells that were drilled and brought on in 2019. Our old type curve went through the middle of those 3 wells. Our new type curve looks like it's better than all 3 of those wells. And it's at least 10% better than the original type curve. And the new wells are performing much better than even that revised upward type curve. You can also see the players in the area. In the north, in the khaki color, you can see Baytex. In the south, in the red color, you can see Paramount. In the gray, you have Spartan Delta. And then in the orange, you have our joint venture with Spartan Delta. So Spartan Delta has the gray lands around us, plus they also have 70% of those orange lands in the middle, and they are the operator. Those orange lands alone are enough to support 60 net drilling locations. At the end of last year, we had booked the 2 new wells, and we had booked basically 44 gross, or about 12 net offsets. This similar Spartan Delta has a similar chart. This is a chart of using the type curve that we just talked about, bringing on 7 gross 2.1 net wells in 2025. Like I said, we're going to do in the next couple of months here. Drilling 12 gross wells, 3.6 net in 2026, bringing them all on around the same time frame, and then 16 wells every year after till 2030. So this is really a key chart in the presentation. There's basically $1 billion gross, $300 million net capital outlay during this period. This type curve, or this production plot, includes the drilling of 83 wells, all coming on with that type curve. 83 gross wells is only about 40%, just over 40% of our total inventory. So basically, we can do this and ramp our production up to close to 8,000 barrels a day by late 2030. And we've only drilled about 40% of the wells. And the other thing is, although 300 million seems like a lot of capital, what I'll tell you is that by the end of 2030, we'll have pulled more money out of this play than we put into it. So it becomes self-funding around 2027 in this scenario. In this scenario, the average netback throughout this period is about 47.50 a barrel. And that's close to 3 times the net back that Journey would have recorded last year. So a really exciting play. It's going to improve our production, dramatically improve our cash flow. If we look at 47.50 netback and 8,000 barrels a day, it's 140 million of operating income every year coming into the company. And remember, we said that we traded at 3 times operating income. So that's a huge impact on the company moving forward, and the net amount of capital into this play by then will probably be close to zero. So tremendous opportunity heading forward. I'll move on to talk a little bit about our power business. We have a power project that we brought on stream in 2020. We have a number of other power projects that are on the go right now that should come on within the next year or year and a half. We have an initial start date for Gilby in October of 2025. That's about a 15 megawatt project in our Gilby area where our Duvernay is. We have spent most of the capital for that, and we just have the remaining capital there to spend. Mazeppa, we actually bought a functioning power project. It hadn't run in about 7 years, and we've been trying to get it basically turned back on and onto the grid. We've connected the gas supply to the edge of the lease here. We probably by later this year will be testing these units, seeing if they work. The initial start date for that project has been slated as December of, Q2 of or June of 2026. So you can see that the ISD dates, the original ISD dates, moved considerably from the original ones. That's part of the regulatory process here in Alberta. It's a laborious process. It's long. It's slow. It's difficult to put these things on. I think that's going to make them worth more over time. That being said, the power business in Alberta right now, fairly challenged in terms of pricing. In the near to medium term, we have probably more power than we need. You can see the Alberta power prices there. They're well below the historical average. The historical average is about 68 or 6.8 cents a kilowatt, or $68 a megawatt hour. It peaked up to, much higher than that in 2022. In 2022, Journey's power bill was about $22 million. In 2020 was under 5. In 1 month in 2022, our power bill was only 600,000. In 1 month in 2022, it was over 3 million. So that kind of volatility is the kind of volatility we seem to be seeing in the grid as we get more wind and more solar projects, and we seem to be seeing much more volatility in pricing. So in my view, over time, that volatility will increase because these things can be turned on and turned off, because they can participate in both ancillary services and in energy services, because you can almost be paid even when you're not using these things. I think there's upside to the pricing that's in this chart, but what we put in this chart is basically your gas price and your power price, and what we think the cash flow for the 30 megawatts of the power business is going to be for us. It's still significant, and especially significant in the fact that it doesn't decline, and it should trade at a high multiple. I'll also talk about Medicine Hat. That's a 310 million barrel polymer flooded pool. If we look at Medicine Hat, we have 72% operated working interest in this pool. We have 34 undrilled locations. We'll talk about the upside in this pool, but the key factor that's interesting, point number one, you can see the shaded areas on this map. Those are the areas to this point that have been polymer flooded. We have a polymer flood blending facility in the north and in the south. On this chart, you can see the north blending facility in the picture in the bottom left-hand corner of the chart. We have about 34 wells booked in the 2P wedge. If we look at the PDP on this property alone, it's close to our current market cap. If we look at the 2P with the 34 development wells in there, which is the wedge shown in orange, that's basically our enterprise value, our market cap plus our debt. So our market cap is the red, the infill wedge is the orange, that's our debt. And then the upside is that gray arrow. And if you look at the top of the gray arrow, that's probably where the polymer flood forecast can go. We can keep this thing flat at about 1,500 net barrels well into 2040 or 2050 by expanding that polymer flood throughout the field. And none of that incremental polymer expansion is booked. The only thing that is booked is the stuff that's actually currently under flood. So a tremendous resource, a tremendous upside. Years of free cash flow are going to come off of this, and that free cash flow is going to go into projects like the Duvernay and help us continue to grow our business. So our base business has a lot of characteristics that many people would find desirable. It's a low decline, predictable. It's well financed. Like I say, we have a $38 million convertible debenture, which terms that debt out till the spring of 2029. And then we just have a brand new, largely undrawn bank line, which is a series of three bank debt tranches totaling $55 million. So it's clearly undervalued in our reserve report. Like I say, you buy Medicine Hat, you get all the rest of this free. Low risk drilling in many fields like our Matsuwan and our Harrington and our Skip fields. We have lots of potential for incremental drilling. We have incremental gas drilling in our Westeros areas and in our Gilby gas asset. And then we have, again, all of the Duvernay. So if I kind of sum up where we are, on the conventional side, we have 1 billion barrels of oil in place. Ultimately, we're only going to recover about 16% of that, which leaves a significant resource behind as commodity prices improve to access more of that. If we could just basically increase our recovery factor by 2%, we could basically double our PDP reserves. So tremendous resource having all of that oil in place. But with that, I mean, obviously we have, a slightly higher cost structure on a large part of that conventional business. And that's where the Duvernay is going to come in to help us reduce the corporate cost structure overall. You can see here our inventory in the projects, our southern projects, central projects, and then the Duvernay. You can see the 200 gross, 60 net wells in the Duvernay, and you can see that only 20% of those have been booked. So as far as our booked projects are concerned, we booked almost 400 million in capital projects. Of that, a good chunk of it, almost a third of it, is the Duvernay. That booking, that 400 million of proven plus probable future development, adds reserves at about $11 a BOE. It adds about 400 million in value to the mix over the 67 million outstanding shares we have. So a tremendous booked inventory, but then you can see as we move from the book to the unbooked, the Duvernay becomes an even more significant part of our future moving forward. And that's why we kind of title this slide that drilling inventory is growing in unconventional ways, because that Duvernay is becoming a bigger and bigger part of what we're going to be doing moving forward. You can see the economics here by price. We're probably on the far right-hand side of each of these curves now with the drop in oil price temporarily after Liberation Day. You can see that the Duvernay is pretty significantly affected on the IRR by the drop in price, but it still is one of the best IRR projects that we have. But what's really important in the Duvernay is that it's not as affected even in the payout period, and that's because you get the production back so quickly. Now, we had pretty good prices last December and last January, but what I'll tell you is if you spend $10 million on the Duvernay and you look at the annualized cash flow in the first couple of months when these wells come on, it's 20 million. So the annualized cash flow coming off of these wells is about twice the capital. It looks like they're only going to pay out in 6 months. Obviously, they take longer than that because the wells decline off hard. But even though they decline off hard, they have tremendous economics, but what's more tremendous about the play is the fact that you get your capital back very quickly. So the reason we frack the Duvernay wells now, the reason we drill them in the winter is because the flow of water into water reservoirs is an order of magnitude higher in the spring when you have the winter runoff. You can build ponds, dugouts, fill them all with your winter runoff, and then use that water towards the completions in, call it May, June, July. So in
And
our
how much is
view,
that, sorry, Alex, how much does that save you by being able to use the water from the runoff, spring runoff, as opposed to, people who don't have
yeah,
the.
I'm not 100% sure that it's the savings itself. Like that may be relatively small overall. You may be able to run lay flats 40 kilometers from like a Red Deer River, and it may cost you maybe $1 more a barrel or whatever it is. But it's largely, in my view, related to the social license in that as we run into August, September, you may not be like, and if you're doing one well or two wells or three wells, I don't think any of this is a big issue. But if you're doing a 16 well program and you need 1 million cubic meters of water, and you want to do that program from August through December, you may not have the social license or the support from the community to get that much water. The community support is better if you try and get that water when there is water, right? So if you're taking water when the farmers need it, or if you're taking water when it's not sitting on the surface. So once that water is off the surface, once that snow's all melted, it's gone. So now you've got to go further afield to get it. So there's the logistics of going further afield to get it, which add to the cost. But what really it does is it adds to the social license. It makes it more difficult, and you'll have a lot of objections to bringing water from all of these disparate sources in order to complete the program. So it's more of a logistical thing.
Okay.
So when we look at where the company is headed over the near term, as I mentioned, Journey is long on net asset value. We have a lot of net asset value, but we're short on operating income. So the key for us is that the Duvernay netbacks are 3 times Journey's corporate netback. And as we spend all of our growth capital, or a significant chunk of it, on the Duvernay going forward, we're going to have a rapid increase in our netbacks and a reduction in our operating costs, probably a reduction on our royalties as well, and a huge uplift in terms of funds flow or operating income per share, which will help revalue the stock. Next is the sustainability aspect. Obviously, the Duvernay has the sustainability, but so does the power business. The problem with where Journey sits today is that we have invested close to $30 million in those 2 facilities, and they're not on yet, and they're not contributing to cash flow. So by the end of this year, and then by mid next year, those facilities are going to stop being a drain on capital resources, and they're going to be a contributor to the program. And because fuel and power is our #1 operating cost, at times being as high as 25% of our overall operating cost, we feel that the sustainability of the company is going to be dramatically improved by having these projects. If we have very low power prices, these projects don't make as much money, but we have lower operating costs. If we have very high power prices, we have very high operating costs, but these projects make enough money to offset that fuel and power costs. So that also improves the sustainability of the company. The Duvernay will also help us drive up our net asset value, and so will the power business, because we don't have anything booked for the power business, and we have very limited bookings in the Duvernay moving forward. And the next step for us may be to rationalize our asset base. As the Duvernay takes more capital over the upcoming years, we will have capital for Medicine Hat. We will have capital for Skiff. We will have capital for other projects, maybe not this year, maybe not next year, but certainly in 2027 and beyond, we will have lots of capital for those projects. But because the Duvernay takes such a significant chunk of our capital, we're not going to have capital to chase every single opportunity we have in the company. So, as the Duvernay cash flow wall comes into the company, it'll give us a chance to rationalize some of our higher cost assets and, grow. And that'll help us reduce our cost structure. It'll help us reduce our ARO in any event, because the Duvernay is adding value without significant ARO, and the power business adds value without significant ARO. The value of our base to our ARO is going to improve in any event, but rationalizing our asset base might actually help that accelerate even faster. So those are the long-term goals for the company. And in keeping with that, we did a small divestment in the first quarter. We talked about it. It's about $3.5 million. We sold a property in Brooks, Alberta. We are still looking at some other asset sales, but we haven't consummated any other asset sales since that sale. So that's essentially all I wanted to talk about today on the presentation, and I'd be happy to open it up, Jessica, for questions. And thank you, Adelaide, again for hosting us.
Okay. Just on the non-core assets, you sold one last year and then one in the second quarter. In the first quarter. Do you have more non-core assets to sell?
Yeah, we have some assets available right now. It's pretty minor. I'd say it's under $5 million. We are looking at one slightly larger asset sale and have got some bids on it, but we're still trying to decide. I think where we see it right now is if oil stays in this $63 range, there is really no impetus to rush out and sell a lot of properties. We're easily funded for this year. We've got a $55 million capital program. That program was front-end loaded. So we've drilled 8 Duvernay wells, and by the end of June, we'll have completed 7. So that's 30 million of that program. Then we have some end-of-life costs in that program, and then we have our power expenditures in the program. That basically rounds that program up with land, seismic, and the other odds and sods to about $55 million. Net of that asset sale, probably low 50s. So that low 50s more or less matches our cash flow. So what you'll see is we kind of ramp up our debt a little bit at the beginning of the year and then pay it all off in the second half of the year. And that's kind of at these kind of current commodity prices. If prices pop up to $70, our debt's going to go down and we're going to be in even better shape. If prices drop into the 50s, our debt could go up and we could be in slightly worse shape as we head into next year. Next year, we're going to need more capital. So the Duvernay capital is 30 million this year. Next year, we won't have the power projects as much, so we'll have less power capital, but we will have more Duvernay capital. I don't know how much more. It may be 45 million, it may be 60 million, but it's significantly more than the 30 million, and it will be front-end loaded. So that's where the bank line comes in. About 25 million of that bank line is dedicated to Duvernay capital expenditures. So we'll be drawing on that in the first half of next year, and we'll be paying it back in the second half of next year with the Duvernay production. So because this is largely a self-funding exercise, it's wonderful to have a bank line versus term debt. And we're hoping that by the end of the year, we can take this bank line and maybe turn it into just a straight $55 million RBL, draw on it early in the year, pay it back in the second half of the year. And we're hoping that as that grows with the Duvernay, that's how we basically fund the Duvernay expansion moving forward.
Okay. We've got a few questions from the audience. You already answered the power assets aren't in the PDP value right now. So
yep, they're not.
Okay. And then on your tax pools, to what extent can it be used to offset future tax? Is there any time limitation?
We've got about, I believe if we go back to the, sorry for whipping through this all the way backwards, but I'll go all the way back to that original slide here. Tax pools there on the bottom, 657 million, 359 million of those are non-capital losses. So, I mean, those are the better pools that can basically be used to offset future revenue. So I would say that, you know, even when you look at our PDP of 350 million, with the kind of pools that we have, yeah, it's a tremendous asset, and we definitely have more pools than we need in the near term. But as we quickly ramp up that Duvernay cash flow, we'll start chewing into those.
Okay, and then so that will lead me into what oil price causes trouble on debt repayment given the production outlook?
Well, again, we don't have a lot of debt right now, and most of our debt is termed out till 2029. So debt repayment, not so much of an issue. However, in terms of funding future capital obligations in the business, I would say anything below $60 gives us a little bit of heartburn, because if we're, you know, a $2 drop in the price of oil, as you can see in our business plan slide, is about a $2.1 million drop in cash flow. So if we get into the kind of mid 50s and you see this, you see the curve where we're at $60 and let's call it 240 and $60, 40 million dollars of cash flow, we're going to spend probably a net of 50 million this year. So our debt's actually going to go up. Next year, I'm thinking that instead of a $50 million capital program this year, we're probably going to have a $75 million plus capital program next year. 75 million plus. We're going to have more cash flow next year because we're going to have more Duvernay production. So don't use this as an example for next year, because next year our production is going to be a lot higher. But at the end of the day, I'd say any kind of price in the mid 50s is going to be a problem for us between now and the middle of next year. It just may mean we ramp up our debt a little bit further. That being said, as we get further out into that business plan into 2027 and 2028, the Duvernay becomes such a significant part of our ongoing operating income, and it has such a high net back, that the reality is that we can actually survive at lower prices as we start to put more and more Duvernay in. So we're building resilience against future price shocks as we add Duvernay. However, right now, because we're just starting this build out, I would say prices in the mid 50s give us heartburn.
Okay. All right. Can your polymer flood also incorporate CO2 injection as well in due course?
We haven't really anticipated injecting CO2 into the Medicine Hat Reservoir. I think part of the issue might be the corrosivity, the equipment that we have, what we would need to bring CO2 there. So we've not really considered that. Our polymer's in the neighborhood of 30 to 50 centipoise, the way we build it up. So you're taking water that has like 1 centipoise, and you're, you know, trying to jack that up to 30. So we alternate sometimes water and polymer in slugs. However, we're trying to increase the viscosity and increase the vertical sweep in the reservoir, and I think CO2 would just override and go right to the producers. There's pretty tight spacing in this reservoir, so I'm not sure that CO2 would give you much incremental recovery anyway, but we've never considered it.
Okay. And then, I mean, EOR is not really a possibility really in the Duvernay. That's correct.
I believe in some of the shale reservoirs down in the south, you have seen some people do kind of a huff and puff gas injection. Like our wells are on gas lift right now, but we have seen people put compressions on pad sites and re-inject the gas and then produce it back. And that's, but we haven't really studied that for the Duvernay. Long term, is that a possibility? Who knows? The reality is that we do have a gas plant there. A lot of this production is flowing to Journey's 1 of 4 gas plant, which is where the power plant is being built. So we do have infrastructure there. We could potentially re-inject some gas at a future time. Obviously, the Duvernay is too tight to water flood. I think that the primary potential in the reservoir and the storativity in the reservoir, it's so large, is so great, and the value of upcoming reserves is so great that the EOR consideration is a long way off. You've got 20 years of just primary drilling, and so I'm not sure at what point you would try and consider trying to change that mix.
Yeah, you're a long way away of
Just to give you an idea how big the reservoir is, because we just sort of did this for the staff. I'm in a 10-floor office building here. It's a pretty big office building in terms of footprint, but it's about 40 meters high, and it's about the height of the Duvernay Reservoir, this building that I'm in right now. And our joint venture is 128 square miles. That's about 50% of the size of Calgary. So just our joint venture alone, and that's not the extent of the Duvernay, but just our joint venture block alone covers half of Calgary, the height of our 10-story office building. So you think about the size of that reservoir, and it's all pretty uniform. It's all between 30 and 40 meters thick. It's all pretty similar stuff. I think when you start to see the results of the wells, you'll start to see that a lot of these wells are looking exactly the same. And I think this is going to really impress people. And the whole size and scope of the project is something that I don't think is fully appreciated in the marketplace yet.
Okay, with WTI hovering around 60, are you looking to reduce capex in the future as net returns are now significantly lower than was expected? I mean, you're not really in control of the Duvernay spend, so.
Yeah, I mean, at the end of the day, this year's capex is largely spent. So reducing 2025 capex is a non-starter. And next year, we're not sure what Spartan's going to do, but we're sure that it's going to be more than what they're doing this year. And we feel pretty strongly that these are the projects that the company needs to participate in to take it to the next level. Now, this year, we're testing some different concepts. We're in the 4-well pad that we're doing. A couple of those wells are going to be maybe at a slightly lower sand intensity than the other two. We've been testing drilling in the lower part of the Duvernay versus the upper to see which one drills faster and whether or not the wells are any different. Long story short, we're testing a lot of concepts this year. The rates of return are lower because of the lower oil price. These wells do produce a lot of oil right out of the chute. However, the payout periods are still tremendous. The economics are still tremendous, and we're learning. So I think those learnings need to happen this year. That needs to happen. That needs to design the program for next year. That needs to design the program for future years. We really need to do this. We need to dial in the costs. The costs are coming down as we go to 3-well pads and 4-well pads from 2-well pads. We really need to do all this work this year. We needed to do it anyway. We need to have some history on these wells so we can plan. So probably no matter what happened, we wouldn't have changed this year's program. But as we go to next year's program, I would think that Spartan Delta would be looking at next year's program in the context of the broader markets. So if oil was $50, are they going to want to be drilling, 25 wells in the JV and then completing them all and bringing on that oil at $50 oil? Probably not. They will adjust their program to the commodity price, and therefore we will adjust our program to the commodity price. But essentially, from a growth capital perspective for 2025 and 2026, all of our money is going into the Duvernay and nowhere else. So we really have a program that we can't really adjust.
Okay, and just can you remind how much of your current 2P on a dollar basis is from the Duvernay?
The 2P on a dollar basis for the Duvernay is probably about $150 million.
Okay.
And
And
the
one last,
2P, if I go to the 2P value, the 2P value is 833. So it would be about 150 of that 833.
and then one last question. When will you expect to be able to buy back shares in a significant way, considering the near term, in the near term, your cash flow is pretty much committed to the Duvernay, repaying the bank term debt and completing the power plants. But you've pretty much done all your spend on the power plants at this point, right?
Yeah, we've got a little bit more to spend this year and a little bit more to spend next year. I think about 12 to 13 million or whatever it is to finish them off. But and that depends on what the ultimate grid connection costs are in Mazeppa. We don't quite know all that yet, but I think we're getting a better handle on what we need to spend in Gilby to finish that off here between now and the end of the year. So back to this slide. I think the 2 points, I try to make the points in this slide. Journey is long on net asset value. We have way more net asset value than we need, but we're short on operating income. And so our PDP NAV is 433 a share, and we trade at a fraction of that, $1.80 or $1.75 a share. So the reality is the share buyback works primarily on increasing our net asset value. And the Duvernay works primarily on increasing our operating income. Now, each of them has an impact on the other, but if we look at the two unique characteristics, that's the way it works. So in our view, it would be a disaster to spend $10 million buying back shares and then have to go penalty on $10 million of Duvernay drilling. That's not something that we would choose to do. So this year, you're right, all of our capital is going into the Duvernay. There probably isn't a lot of leftover capital going into buying back the shares. The better the Duvernay gets, the more money we want to plow into it. The more the Duvernay helps our netbacks and helps everything, the more we want to plow into it. Clearly, by 2027, this becomes self-funding, and it then becomes a significant issue. Now that the Duvernay is self-funding, do we pay a dividend? Do we buy back our shares? What do we do? So one of the things is if you rationalize your asset base and you sell a significant asset, can you take a portion of that money and buy back shares? That might be one way that we would buy back shares. That being said, if we were to aggressively buy back shares in any way, we would have to have a discussion with the banks who gave us the new bank line. Return of capital to shareholders through share buybacks and dividends is not something that's anticipated in the current bank line. Although I'm sure if we talk to them in the context of selling an asset or doing something, they may be acceptable and amenable to it, but it's not a guarantee. So again, you want to buy back the shares at the bottom of the cycle, but you also want to drill the Duvernay at the bottom of the cycle, and you want to get this play moving. You want operating income. You need to improve the company's netback. So right now, if you look at what we're saying, is that we have too much NAV. That's the chart in the bottom corner. We don't have enough operating income. That's the chart in the top left corner. So we want to focus on adding operating income. We want to focus on developing the Duvernay. But we will consider buybacks in the context of a large asset sale if one of those occurs at some point in the future.
Okay, and then I have one. I mean, obviously, you've got some pretty attractive assets, and I mean, I'm sure Spartan Delta would like to own all of the Duvernay that you share with them. But given the ownership situation, do you have people knocking on your door?
I believe we do. I believe that people have approached us. People have also approached some of our larger shareholders. I'm aware of a number of approaches directly from the larger shareholders. They've told us that they've had a number of approaches. So there are those approaches out there. There are ways to do it. You could sell all of Journey. You could just sell the Duvernay. You could sell the Duvernay in the corporate shell with the tax pools. There's a number of different scenarios out there. When we look at all of the opportunities out there, we really like Journey's future with the Duvernay in it. If you focus on that future and you focus on that curve and you focus on the self-funding nature of the property by 2027, and then you start to think about between 2027 and 2030, how you could return capital to shareholders. As a shareholder, as a selfish shareholder, I think it might be a bit early to aggressively pursue opportunities to shed the Duvernay out of the company. Obviously, opportunities to merge the entire company, you have to look at them as they come in where they're at. And we're trading at such a significant discount that you could get a very, very significant premium to the current NAV and still make it accretive for other companies. But I think as we continue to add operating income, and as our operating income becomes kind of a better, like I say, we don't have enough operating income. We have too much net asset value. People aren't paying for the net asset value. They only want to pay for the operating income. So as we add the net operating income, and as we see that impact in the shares, I think you're going to see better valuations for the company, and the company is better off waiting for those better valuations rather than rolling into something right away. We have a 32% block of shares with Aimco and management and directors. And so I think that'll encourage people to approach us more through those two avenues, through the front door or through Aimco, rather than through the back door, through any kind of hostile thing. So I mean, I think those approaches are always there. I think as we have more Duvernay results, they'll accelerate. But I still think that, we're in a really good position to wait and let this unfold a little bit first and improve the valuation of the company before we do anything rash.
And hostiles don't work that effectively in Canada, as we've
No.
seen. One question, why wouldn't Spartan Delta start buying Joy shares as an indirect way to buy more of the Duvernay?
I don't
I guess
know.
it could be, for all you
That's a
know.
question for a Spartan Delta webinar.
And what value will you ascribe to the power plants once online?
Well, last year, in a better power pricing environment, we thought they were worth about $90 million. Since then, the carbon tax has not gone up to $230 like was forecast, but Alberta's capped it at 95. The cap at 95 actually improves the value of those projects, but the current macro in the pricing environment for power in Alberta is really poor. And as an example of that, you can see in our presentation that Countess only ran for about 30% of the time last year. So these projects were on, they may not be running, may only be running at 30% of the time. We may get a better than average power price, but we may get that better than average by only running them when power prices are high. So the reality of the situation is the value is going to be lower than that today. So is it 30 million? Is it 40 million? I don't know. But I do know one thing. It's hard to get these things on the grid. In general, if it's very difficult to get things on the grid, things that are on the grid become more valuable over time. We've been looking at or receiving a lot of interest in our Mazeppa project. Based on that interest, I know that there's some people that would ascribe some value to those. Would these things be valued at $40 million today? Maybe that's a good round number to say that both Gilby and Mazeppa would be valued at $40 to $50 million today. But I think they'll go through periods in their history where they're valued at over 90 or 100, and they'll go through periods where they're valued at less. And I think maybe this is just one of those periods where they're valued at less. I think because it's a long-term project, I'd hate to pin a value on it today based on a forecasted power price, which may be completely wrong. When we first brought on Countess, we were using 5.5 cents a kilowatt for power. And within the first year and a half, Countess paid for itself at power prices that were about 12 to 13 cents a kilowatt. So we've been notoriously bad at forecasting power prices in the future in this province. I think we'll go back to the historical averages, about 7 cents a kilowatt, but I think we'll have significant peaks higher than that. So, like I say, as of today, I'd say maybe $40 million for the two of them, but that value is subject to higher valuations later on.
Okay, great. Well, I have no more questions. Again, if anyone has any further questions or would like a private meeting with Alex, please email me at jessica@adcap.ca. A great presentation. I think you're just on the cusp of really getting going here in the next few months. And I'm like, I think we're kind of bottomed on oil, and so I think everything's kind of percolating in the right way, but I wouldn't want to go on the record as saying that necessarily. But I think we'll see some very exciting things over the next few months out of you, and please keep us up as soon as you said maybe as early as July we should have some
Yeah, so
results.
those wells, like I say, the number 3, those wells are on. Now the third well has come on. We had to shut in the second well to bring it on, but those 3 wells will be on full time sometime in the next week or so. And then the wells at the pad 4, those 4 wells, they're being completed now. They'll be done by the end of this month in terms of completing. So they'll start coming on in July. I think it's unlikely we'll be able to bring on all 4 at the same time. But I would assume 2 to be on in July and 2 to be on in August, or maybe all 4 to be on by August. So by August, we may have all 7 of these wells on, and August might be a tremendous month. In fact, in August, we may be getting as much cash flow, and only for a short period of time, we may be getting as much cash flow from the Duvernay as we're getting from the rest of Journey.
It's exciting.
Yes,
Very
it is.
exciting. Okay, awesome. Well, thanks so much for your time, and we'll check in soon with you.
Thank you very much, Jessica. Thanks to
Okay,
Adelaide. Thanks,
take,
everybody. Thanks
take
for
care.
attending. Bye.
Thanks.